Hello, friends. This is Jennifer Roy with AMCAP. Today I'm going to talk about key economic indicators and the roles they play in the mortgage industry. This year has been really volatile when it comes to mortgage interest rates. So we get a lot of questions of what do you think is going to happen? What's it going to look like next month? I'm going to start shopping this fall. Are mortgage rates going to go up, down? Are they going to hold? What do you think? Of course, we don't have a crystal ball. I wish we did. But what we can do is just study the markets and see if we find any trends that are occurring and try to give an indication of what we may think could happen. But in general, there are a lot of parts and pieces that have to work together, and it does, especially this year, change quite frequently. So one of the reasons this pops up is because there's been a lot of conversation this year of Federal Reserve hiking up prices. And every time that starts to blow up to the surface, we start getting lots of questions of, oh no, what's that going to do to mortgage rates? Especially when it happens one day and then it's the next day. Well, there is not a direct correlation between the Federal Reserve raising rates and the mortgage rate industry interest rate. However, all kind of tie together when we look at the larger economy. Interest rates on the mortgage industry is more tied to 10-year Treasury bonds. So when you see bonds increase in price, the yields come down and the interest rates come down for mortgages. Inversely, when bond prices come down, bond yields increase, so do mortgage rates. So, I wouldn't say it doesn't look at Fed Reserve at all because, like I mentioned, everything is tied together. So what we may sometimes see is if those rumblings are happening, the Federal Reserve is saying, oh, next month we're going to raise rates. In anticipation of changes, you'll see different aspects of the market start to react to that. So oftentimes we might see mortgage rates start to increase just on the news that something could be occurring. Like I had mentioned, there are several market indicators that we can follow and try to make predictions of where we think the mortgage rate will fall over the next month, quarter, year. One of them is the GDP, or the gross domestic product. If the GDP is up, so is the strength of our economy. Strong economy usually means we have high consumer confidence, and that usually means we're going to have increased interest rates. But that can be a good thing, right? If we have those really low interest rates, tend to be our economy is not that strong. So it's a balance that occurs within our market, and this is the indicator that we use amongst many others. And some of those many others is a long list, but I'm just going to say some of those direct correlations. Consumer price index, if that goes up, you'll see interest rates inch up. I mentioned GDP, housing starts. If there's housing starts are increasing, you may see mortgage rates increasing. If you're watching the news and seeing reports on what's going on within the economy, that can kind of give you an indication. New home sales, same thing. See an increase in new home sales, chances are mortgage rates will possibly inch up. Personal income goes up, interest rates will go up. Retail sales go up, mortgage rates could go up. There is an inverse effect with jobless rate. If the jobless rate goes up, interest rates tend to come back down. So these are just some of the indicators. If you have questions about what you think the market is leaning towards, and if you have concerns about mortgage rates, want to understand where we are today versus history and where we think this may go, please reach out and I can help you. Thanks.